Hey guys, how are you?
Hello,
Good
hello. Happy
morning.
Sip Day.
Yeah, happy Sip Day. What's on the agenda today? What are we talking about?
I think a good topic, especially given that we're close to year end, is tax exempt versus taxable income and interest.
So
Yeah.
what's that mean, Nav?
So everyone, if you earn interest on a bank account or a high yield savings account or a taxable bond, you're going to pay, it's going to add into your ordinary income. So you're going to pay taxes on that interest that you earn. So, for example, if you have a 1099 from a bank, it'll show interest paid and put that on your tax return. Boom, that adds up to ordinary income, taxes are paid. So that's what we would call a taxable investment or a taxable interest. Tax exempt interest is usually coming from a municipal bond,
Mhm.
which is a bond that is given by a state or a municipality business or within the state that provides income that is tax free from federal. And if it is within the state that you live in, can also be state tax free. So that's tax exempt interest.
Mhm. Why do municipals exist? Why do these kind of instruments exist for people? What, right? If they're tax advantage, what's the perk?
When I think about it, it's for both for incentive. So usually, if it's for say like a toll road,
Yep.
that can be tax exempt interest, and they need to have money to build the toll road. It's supposed to be more efficient for the people that's living in the state. So to get the money to do that, they give out bonds, and then the bonds that investors invest in give a direct benefit to people in the state when the toll road's there, and the interest that you're getting back is tax free.
Yeah.
So it's a lineup of incentives to both better people's lives as well as give another instrument of a way to invest in your state and then nationally as well, because anybody can buy those bonds from any state.
So why
Yeah, Nav, I
not
get the
go with
comment a lot of like, well, I don't really trust my state to manage their finances, right? So kind of what's your counter to when you hear that topic come up from somebody?
Counter and what? Say that again, Joe.
Yeah, somebody I get common when I hear about this is what you just said is like, okay, investing in the state, you're loaning
Right.
money to the municipalities in your state, you're getting a tax benefit. But what do you say when the client says, I don't really trust my state to manage its finances. There's not a great history of, fiscal responsibility there. Like what's your response to that?
I mean, it's usually it's a great point, and the fact of the matter is, we have private corporations that also invest within the state. But reality is, the state is going to have their budget. They're going to have their investments that they want to make,
Mhm.
and the best thing you can do is either take advantage of it by investing in it, or hey, go elsewhere with your money, because of course it's your money. And there's other ways to benefit from the things that's going on in the country and state.
Yeah.
Or another to diversify outside the state, right?
Yeah,
So if you think the one particular state, we're filming in different states right now, the three of us. So if you think one state's not managing it well, diversifying amongst 50 different states, you're helping then hedge that risk of a poor creditor. I think
right.
the other one I think about too is when we probably shouldn't rely on this, but in past situations when a state has run into financial trouble, it's like the federal government, kind of in our system of decentralization of different states and then a federal system. The federal government has backstopped a lot of those states in the past. So although we probably shouldn't count on that occurring, that is something that we've seen historically and just saw a few years ago in COVID, where we saw the federal government shore up some of the state budgets that took a beating during that time period.
Yeah.
So explain to me and the folks watching why you would not pick a municipal then, right? They're tax advantage, you're helping your local authority. So why would you not pick it?
Yeah, and the when you think about the yield that you're getting from bonds, there's the upfront yield, so the nominal yield, say it's 5%. If you're paying taxes on that, your actual yield, the real yield you're getting, will be lower than 5%, right? Because you have to pay taxes. If you're in a low tax bracket, that might mean that you're not really paying that much. Your real yield is going to be much higher than someone who's in a higher tax bracket. So if you're in the 25, 30+% tax bracket, you're paying 30% in federal taxes alone, plus another, 5%, 6% state if you live in a state with taxes. So your real yield is much lower. So then
Right.
you look at, hey, I can actually get, even though the nominal yield on municipals are usually lower than the nominal yield on taxable bonds, when you look at a taxable equivalent yield, it could actually be higher. So it's not the best for everyone in terms of maximizing income, because if you're in a low tax bracket, maximizing income would really mean, hey, you can get the higher nominal yield on federal or taxable investments versus tax free.
Right, which I'm sure
So
is a
let's say
direct
this is
correlation to which states you live in and if you're not having to pay that state tax.
Right. Both state tax and also, even if you're in a state with no state taxes, the tax equivalent yield on federal, if you're in if you're in Florida or a state that doesn't have state taxes, but your income is in the highest tax bracket, that tax equivalent yield is still going to be better for you in a tax free bond than a lot of taxable bonds.
Right.
Yeah, this isn't a trick question, but you're drawing the board here. If you have a choice between 5% taxable and 4% tax exempt, we don't even know which one's better.
Right.
Because the missing fact here is, well, what's the federal income tax bracket of the person we're talking about? If this is, somebody 90 years old with no income, probably 5% taxable is better because they're not in a very high tax bracket. If this is a 45-year-old in their peak income earning years, in this case, 4% might actually be greater than 5% because the 4% is net. So the missing fact here is what's the tax situation of the person who owns the investment. But this is an important thing to think about because what we care about is your net tax after fee return. Because if you're getting a taxable 5%, you lose all your tax account.
He broke up there a little bit, but I think the
Or
moral of the story is
no,
the net returns, right?
Yep, the net returns between the 5% and 4%. And what Joe's was is going to demonstrate is the easiest way to find that break even point is actually taking one minus your taxable rate. So say you're in the 24% tax bracket for federal. So you would subtract one minus 0.24, that gets you 0.76. And all you do is divide that 4% by the 0.76 and you get 5.26%. So that tells us right there that between those two, the muni bond, the tax exempt bond would be a better investment for you net than the federal taxable
Yeah.
bond.
The moral of the story is you could help your local government. You could make a better return that's, tax efficient for you. Obviously, retirement accounts aside, right? Might not make sense there.
Right.
But either way, that's a good part to, or a good time to talk to your financial advisor, bring them in. They can help you assess the tax break, or tax bracket where you're at.
Exactly right.
All right. Thanks, guys. Good seeing you.